everyone. Thank you for joining us on the Q2 FY19 results conference call of Edelweiss Financial Services Limited. We have with us today Mr. Rashesh Shah, the Chairman and CEO, Edelweiss Group, Mr. Himanshu Kazi, the Executive Director and Group COO, Mr. S. Ranganathan, President and Chief Financial Officer, Ramya Rajgopalan, Executive Vice President, Corporate Development, and Salil Bava, Head and Senior Vice President, Stakeholder Relations. Before we begin, I would like to state that some of the statements in today's discussion may be forward-looking in nature and may involve certain risks and uncertainties. A detailed statement in this regard is available on the results document shared with you earlier. During the discussions, we will be referring to two presentations, the Q2 FY19 investor presentation and the addendum presentation uploaded to the exchanges. With that, I would like to now invite Mr. Rashesh Shah to begin the proceedings of the call.
Thank you, and good afternoon to all of you. And again, a very warm welcome on this Q2 investor call. As you would have seen from the results, it was a good quarter. We had profit after tax consolidated of 272 crores and profit after tax excluding insurance of 322 crores. So our growth momentum that over the last 30 quarters has been there continues in this quarter in spite of some headwinds towards the end of the quarter. For this quarter, we also had ROA excluding insurance of 2.5% and ROE of about 19.1%. So more or less growth and business as usual in this quarter. Customer assets have also grown fairly well. We now have 2,47,900 crores of total assets. Credit book is around 49,000 crores, out of which about 21,000 odd is retail credit, and our GNPA is 1.78 with NNPA at 0.79. Our ARC business had a good quarter. Our wealth management also has now come very close to 1 lakh crore of assets under advice. And our asset management business has now also grown to 35,000 crores of assets under management. So both businesses have done well, steady growth in flows. We've also been talking about the importance of liquidity cushion for the last, many years, because we have seen 2008-9, we have seen 2013. So we have also seen the importance of liquidity cushion at times like this, which is also maintained very well. And we continue to have about 9 to 10% of total balance sheet and about 11 to 12% of our total borrowings as liquidity cushion. Our diversified model continues as we go along, and I will speak a little bit more about each of our businesses after my colleague S. Ranganathan gives a slide overview on this quarterly numbers and the balance sheet, and then I will give more color on each of the businesses after that. Over to you, SR.
Thank you, Rashesh, and good afternoon all of you once again for attending this call. Let me, as usual, take you quickly through the Q2 earnings update. I'm happy to announce that we recorded a profit after tax of rupees 272 crores in this quarter 2 of FY19, registering a YOY growth of 47% over Q2 FY18. The ex-insurance return on equity for the quarter stands at 19.1%. Other highlights, our total revenue for Q2 FY19 stands at rupees 2,672 crores, which is 32% year-on-year increase. Consolidated profit after tax of rupees 272 crores when compared to Q2 FY18 of 185 crores is up 47% on a year-on-year basis. Ex-insurance profit after tax of rupees 322 crores is up 46% year-on-year when compared to Q2 FY18 of rupees 207 crores. The balance sheet size grew from 48,102 crores in Q2 FY18 to rupees 49,433 by the end of this quarter. Consolidated ROA for the quarter stood at 1.9% and ex-insurance stood at 2.5%. Consolidated ROE for the quarter stood at 14.7% and ex-insurance ROE stands at 19.1%. Briefly on the main businesses that fared during the quarter, credit business profit after tax grew 54% year-on-year to 245 crores post-minority. Share of retail credit stands at 42% today as compared to 41% a quarter before. Franchise and advisory business profit after tax grew 9% year-on-year to stand at 76 crores this quarter. This segment has been impacted due to dampened capital market activity during this quarter. Ex-insurance cost-to-income ratio for the quarter was 47%. Credit costs remained well under control with GNPA of 1.78% and NNPA of 0.79% at the end of the quarter. The collateral cover for the corporate book remains robust at 1.9x and the LTV on the retail book stands at around 45%. Briefly looking at the income streams, our fund-based income grew 36% year-on-year to rupees 1,914 during the second quarter of 2019. Fee and commission income grew by 13% and stands at 515 crores during Qtr2 FY19. Our life insurance business continued to grow and recorded a net premium of rupees 184 crores for the second quarter of FY19, a growth of 63%. Briefly talking about the balance sheet, we continue to take steps to strengthen our balance sheet. Our consolidated capital adequacy at the end of Qtr2 stands at 16%. We have a comfortably matched ALM and liquidity profile over the short and medium term. Our long-term borrowings stand at 59% of the total borrowings, and we aim to maintain liquidity cushion of 11 to 13% of the total borrowings. During the quarter, we successfully raised 2,000 crores by way of public issue of retail bond in our leading NBFC, ECL Finance Limited. Our debt-to-equity ratio, excluding treasury assets, remains at a stable level of 5.2 times as at 30th of September 2018. Edelweiss continues to get access to funding from money market and banks. We have raised 2,500 crores since September 21st, including 1,450 crores by way of commercial paper. We have adequate liquidity cushion and estimated business inflows currently positions us to meet all contractual liabilities over the next 6 months comfortably. As on date, we have 7,600 crores due till 31st March 2018, of which 5,500 crores in the form of commercial paper. Therefore, we don't see any challenge in respect of in meeting these obligations. With this, I complete my speech. I would hand it over back to Rashesh for his part of the communication.
Thank you, SR. We have been getting a lot of queries and feedback from investors, and there are about 7 or 8 questions that most of the investors are asking us. So I thought I'll just, instead of having a standard commentary, I'll just try and answer those questions. So I think the first question that a lot of investors have been posing has been, how do we see the current liquidity situation in the market? And as we all know that we are feeling the impact, the entire industry is feeling the impact, but in the last 8-10 days, things are starting to open up. We are seeing volumes in commercial paper and all starting to come back. My estimate is that we are now at about 30% of the normal volumes. Fortunately, banks and all are still active. The bank, approvals and all are coming. Bank lines are still there. But on the bond market side, volumes are currently at around 30% of the volumes. I would expect that by end of November, we should hopefully get to between about 60-70% of the normal volumes, which in our world would say normalcy has come back, and the kind of fear psychosis or confidence crisis or whatever people were calling it, which was there a couple of weeks ago, has started abating now. So things are maybe 1/3 of normal, but the trend is very positive, and we are hoping that in the next few weeks, the liquidity situation gets back to normalcy. The second question a lot of investors have been asking us has been, how is the Edelweiss liquidity situation? And on that, as my colleague SR just reported, we are well placed. As we have filed a few days ago, we have obligations of about 12,000 crores to repay till March, against which we are holding liquidity cushion plus the treasury assets plus the loan against shares book. All of that is around 13 to 14,000 crores. Along with that, we also expect in the next 6 months around 3,000 crores coming to our ARC business. We get normal inflows about 400-500 crores every month in our credit business, which would be another 2,500 to 3,000 crores. And we have about 6,000 to 8,000 crores of bank lines in the works, which are either approved or getting approved as we speak. So all this is without estimating any inflows from the mutual fund market, which also we think will open up soon, and commercial paper as well as NCDs will also start coming in some form or the other over the next few months. But even without that, with the bank market, with the business receipts we have from ARC and credit business and the liquidity cushion, treasury, loan against shares, highly liquid credit books we have, we will manage the liquidity. Obviously, we want to have the NCD bond market opening up and the liquidity coming back to normal so that we can aggressively pursue the growth agenda that was there. I think for the next 5-6 months, most of us will be careful in managing liquidity, and only when normalcy comes back, the growth will start coming back. Although I think a lot of us will be calibrated in the growth in terms of how we look at the liquidity situation over the next few years. I do think that things like ECB and international markets will also be another source of liquidity for housing finance companies as we go along. The third question that I've been asked often has been the commercial paper non-availability impact on Edelweiss. Assuming the commercial paper market shrinks, what will be the impact on Edelweiss? And here, I'm very happy to say that we have never used commercial paper as an ALM arbitrage tool. So in our profitability in the credit businesses, there is no excess profit which came because of commercial paper utilization. Our commercial paper borrowing was directly for our treasury and what we call the liquid credit book, the loan against shares book. So these are the only two areas where we use commercial paper, and we think if the commercial paper market shrinks, and assuming that it will become half of the normal that was there, we expect that we will have about 4,000 to 5,000 crores of commercial paper outstanding, which means we will lose about 4,000 to 5,000 crores of borrowing opportunity in commercial paper, which was funding our treasury and liquid credit book. These books earn about an average ROA of about 100 basis points. So we would expect that from a profitability point of view, a 50% shrinkage of the commercial paper market should lead to about 40-50 crores of profit after tax impact for us, which, as we always said, in a diversified model is okay and can be handled. We will use other sources of funding also for the loan against shares and other books where cost might go up, but we think we should be able to pass it on to the customers and continue to provide this product and service for our customers also. The fourth question has been on our strategy and composition of a credit book, where I want to again reiterate that we have a very diversified credit book. As I said, out of 49,000 crores of credit, almost 13,000 is retail and SME loans. Another 12,000 is real estate and wholesale mortgages. Another 9,000 is the corporate book. 8,000 crores is our loan against shares and agri book, which are generally short duration and very liquid book with very low NPAs. And the last one is about 7,000 crores of our ARC and distress book. So fairly well diversified book. Especially ARC is also, has also upside and carry along with that. So that also balances out the overall book. So given this, we are very comfortable with some volatility, some turbulence in individual books, and we also ensure that in our credit approach, we get our pricing right. So even the wholesale mortgage book, we make sure we get the pricing right, and we provide also as per expected credit cost. And our approach on providing has been that we provide either as per our model or actual experience, whichever is higher. So the idea is to make sure if you get your provisioning strategy right, you will get a pricing strategy also right. As you may remember, friends, we had excess provisioning of 140 crores in the last quarter when we moved from Indian GAAP to Ind AS, and we chose to keep this provision into the provision kitty itself, and we did not claw this back. This was a very conservative approach and underscores our approach that you should provide as aggressively as you can so that you make sure that whatever is the expected credit cost in a particular strategy is also highlighted in your P&L. And finally, on our credit book, most of our credit book is collateralized, which average LTV of between 45 to 55%. And we feel comfortable that in collateralized credit, your loss given defaults are fairly low because you have very high rates of recovery. The fifth area of inquiry has been around our real estate book and the color on our wholesale mortgage funding book, which as I said earlier is about 12,000 crore. At 12,000 crore, we estimate that we are 2.4 to 2.5% of the total market for this credit strategy. We have built this book over the last 10 years in a very slow and steady manner. We showcase this book to obviously to RBI when they do the inspection, but also to credit rating agencies. We showcase our approach, our book to the credit rating agencies, to bankers, creditors. But along with that, we also have raised our real estate funds, which co-invest along with our wholesale mortgage strategy. So here we have multiple investors over the years who have done due diligence on this book, who have done due diligence on this strategy, and then they have committed funds to co-invest alongside our book. So this has gone through testing from international, external investors also who have looked at the strategy and seen whether the risk reward and our ability to manage this makes sense or not. So on that, I feel fairly comfortable that we have had multiple oversights on this book. As we have seen in our addendum, we do mainly housing in this at an SPV level, so we don't do holdco financing. About 95% of our book is housing finance projects. In 95% of the project, we are the sole lender to the project, which gives you a lot of flexibility in managing risk. Also, 80% of the inventory that we have is under 1 crore homes, which are also fairly where the demand is fairly high and the price elasticity is also fairly good. We also obviously do very strong underwriting, but we do believe in post-underwriting risk management also very closely. And for this, we have a strong project management team and a distribution team. We also have a sales team which can sell apartments, which can sell homes. And this project management as well as distribution team ensures that even post-underwriting, if there is any risk management issues, we are able to manage it. Also, we have ensured that though we will have NPAs like all other credit businesses, we have always ensured that there is generally no actual loss, because when there is collateral and you are proactive and your risk management is robust, then we have found that your recovery rates can be almost 100%. That has been our experience. We have been able to recover money and not eventually lose. So you may have NPAs, but you won't have actual credit loss if you can manage your risk well and be proactive on that. In the last few years, we have done that. Wherever projects were in trouble, we would do step in. We have changed a few developers. We have done last mile funding. We have brought third-party last mile funding to complete projects where there were issues on any project. And we have done this over the last 10 years. We have seen demonetization, GST. So headwinds always come. But I think in any credit business, it is very important to acknowledge that the environment can change, and if the headwinds come, you should be prepared to be able to manage the risk associated with that. The other question I've been asked, friends, has been what is the outlook on the real estate book overall and the business and the housing market overall. Our sense is that the overall housing market should continue to do well. We have had almost 5 years of falling inventory, falling prices. So this current turbulence or headwind is also happening not on an asset bubble, because house prices have not been going up for last 5 years. We have not seen too much investor buying in homes and all. There is only end user buying that has been happening. And for the first half, home sales were fairly good. There was almost an 8% growth in the first half on home sales over last year. So the market is coming back, and as long as Indian economy grows at between 7 to 8%, we think housing interest will be there. India sells between 2 to 2.5 million homes every year. So there will be demand for housing. And along with that, as long as the home loan market is open, which we are happy that, banks and a lot of the housing finance companies are continuing the business of giving home loans in spite of this liquidity. So as long as that goes on, we do think that home sales will continue to drive the housing market. If there are any projects which will get stuck, they will only get stuck because of the lack of funding to complete the project. Because our experience has been that any project that gets completed, especially where the pricing is below 1 crore, it's not hard to sell that. You have to complete the project and not have any hindrances on that. So as long as that happens, and actually we were more worried at demonetization stage on whether home sales will happen. So currently, the outlook currently seems to be that home sales will not slow down, and as long as home sales don't slow down, we do think that the real estate portfolio for not only us but everybody in the market should continue to do well. There will be some projects which will need additional funding for completion, and for that there will be enough funders available, including private equity funds, including ARCs and all, who will step in to provide last mile funding, to provide completion financing and ensure that projects are getting completed. The other question we've been getting is on our ARC business and the outlook on that. So I'm happy to report that the business continues to be robust. We have deployed more funds in this quarter, but H1, the first half year this year, has also seen good recoveries. We have recovered almost 2,000 crores. And we expect to recover another about 10 to 12,000 crores in the next half as the large recoveries around SR and Binani and all start coming in. So we will be receiving funds back, which obviously is good news from recoveries and cash flow point of view, but also, from the book point of view, the question we have been asked, will the book shrink? We feel we have a lot of opportunities that we will also deploy the funds over the next 3 quarters. So as we get the receipts, we'll also be deploying them back because the current pipeline seems fairly good. Also, one of the things in our ARC we have not highlighted is we have a lot of expertise in real estate also. Our ARC has done 4 to 5 real estate distressed asset revivals, whether it was a mall or it was a commercial building, which were incomplete projects and the loans had become NPA with banks. Our ARC acquired those loans, reworked the project balance sheet, provided some last mile funding, and ensured that the projects got completed and recoveries happened for everybody. So we think the distressed asset business will continue to do well. In our distressed asset business, we also have another 10,000 crore fund alongside with that, half of which is undeployed. So we have about 4 to 5,000 crores of a deployable surplus in the distressed credit fund that we manage. And, given the recent environment, our ARC is also talking to many investors to maybe create a focused real estate distress fund, which will focus on providing completion and last mile funding for real estate projects which may be stuck for lack of financing. And the final question is Edelweiss strategy going forward, any changes on that? So I think at this time it's important to reiterate that we are a diversified business, and that has been our strength. We have always spoken about that because even the current turbulence in the NBFC segment underscores that, because though NBFC is part of our business, it's not our only business. Everybody is currently focused on that. We have a lot of other businesses like our ARC business, asset management, wealth management, insurance, capital markets. All of them are growing well, have got huge amount of growth value, franchise value ahead of that, and we remain positive on all those businesses, and on NBFC, we obviously think this turbulence will die down, the liquidity situation will slowly crawl back to normal, and the NBFC, because NBFCs has been a real story. NBFCs have been responsible for credit delivery in India, and NBFCs and banks coming together is a fairly robust model for the credit needs of the country. So though there might be some headwinds in the NBFC business because of liquidity crunch, we are confident that this will not only come down, but our model, which is a diversified model, will also handle this and maybe allow us to be counter-cyclical in that. In our credit business, we'll continue to balance our credit book by growing retail more faster than wholesale. That has been our stated strategy for the last few years. We will do wholesale through the funds that we manage. So maybe our own balance sheet wholesale book might shrink as we get more repayments, while we will continue to deploy on those strategies, both corporate credit as well as on real estate credit through the funds that we manage. In our credit strategies, wholesale credit strategies, we have raised more than $1 billion over the last few years, and there is quite a bit of undeployed capital available on that also. So I think the wholesale business in the fund format will continue to grow. The retail business on our own balance sheet should continue to maintain its growth because we see a lot of opportunity in SME financing, in small ticket home loans, and other consumer-facing businesses. So with that, we think this particular phase will also allow us to highlight and underscore our diversified business model that we have. So with that, I come to the end of my part of this, and we'll maybe open it up for question and answer from all of you. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking your question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viral Shah from Credit Suisse. Please go ahead.
Yeah. Hi, thank you, sir. So I had two questions. One is if you can give us details of top builder exposures in your wholesale mortgage book. So that will actually help us give some light on the kind of builders that we are lending to. So that is my first question. I'll ask the second one next.
No, why don't you ask the second one? I'll answer both of them.
Sure. So now that the SR Steel case seems to be very near to the resolution, if you can give us some sense of what is the kind of gains that we'll be looking at from both the ARC as well as from the Edelweiss perspective. Thank you.
Sure. Actually, both the questions, our approach always has been that we work on at a portfolio level, and our approach always has been that we look at a portfolio as a whole. So whether it's a credit book or an ARC book, there will be some accounts which will become NPA, as we have always stated. Our policy has been not to talk about individual accounts, though as I said, with the credit rating agencies and others, we do showcase our portfolio and our underwriting and the collateral we have and which project we have funded and how we have funded and all that. Because what we have found is without having complete color on the process and the name, because just a name does not help in getting any color on that. Maybe, you feel that you have got the names, but it doesn't tell you what is the risk and reward in the underlying project. We do real estate projects at an SPV level. We do project level control of a very high degree. And even after that, as we have said, a few accounts will become NPA. But I think it's not right to speak about any names and give individual account-wise status. And the same thing applies to SR Steel also. We have always refrained from, if you remember our investor day also, we had given a calculation of how the ARC model works and what could be the portfolio extra profit or carry that will come about, and not want to talk about individual accounts, because the idea of having a portfolio, the idea of having multiple accounts is to make sure that the good and the bad all get balanced out with each other, and the effect is more felt on the outcome of the whole portfolio as a whole. So I think that has been our stated policy. I think on color on the real estate, by giving the names, I don't think our investors will get any more comfort than they have now, because over the years they have had confidence in our underwriting capability, but as I said, in our post-underwriting capability. Because it's a large market, we are about 2.5% of the market, and like everybody else, though currently there is extreme focus and extreme nervousness around this segment of the market, we have currently not seen any change in the last 4 to 6 weeks in that. And our approach is, as and when anything changes on the real estate book, we will come and inform investors and analysts on how the book is doing as a whole. And I do hope that the investors have faith in our risk management capability, on our approach that we have shown over the last 10 years through demonetization, through GST and all those other upheavals that have been there, that we underwrite well, but we even post-underwrite whenever there is a turbulence or there are headwinds, we will know how to manage it.
Yeah, so just basically there we had few peers of ours also who had come out in the calls and given the name, so it was more from that perspective.
Sure, I mean, I understand. I think each company follows their own, all companies are not the same. Everybody follows their own approach, and we have always followed this. I don't think this is the first time. I think about 3 years ago, 5 years ago, also on calls, people wanted to know names on individual accounts. And we always said that it is not, because it has not been our policy to speak about individual accounts. But we obviously showcase all of this when we go through RBI inspection. We showcase all of this when people do due diligence on us, and we are always comfortable with that.
Okay, sir. Thank you.
Thank you. The next question is from the line of Avinash Singh from SBI Cap Securities. Please go ahead.
Yeah, good afternoon. Good set of results, amid all this turbulence. So, 2 questions. First one, okay, not going to the names, but can you please provide some concentration details in both your wholesale lending segment? I mean, the developer loan as well as the collateralized loan. I mean, what percentage of the top 5, top 10 constitutes? And additionally, on the developer, if you can just provide that, okay, geographical breakup, that, okay, which are the top cities and what percentage. And secondly, on the tax rate, I mean, the higher tax rate, is it because of the losses are sitting in the insurance subsidiary? And if yes, I mean, do we expect once the insurance subsidiary turns profitable, the effective tax rate going down? Thank you.
I think on the first one, we always maintain that in all our wholesale books, we have a per account cap, which is usually 1% of the total book. I think our current account cap is about 400 odd crores per account. Our average account is around 100 to 150 crores. We have about 60 to 65 accounts on the real estate book and another about 40, 45 on the corporate book. And it's a fairly well distributed. I think the top 10 should end up becoming about 35 to 40% of the total book. And it's been the same for the last 10 years, where there is a tail and there are few accounts. But we actually, more than the top 10, we look at more the per account cap, because we always said the per account cap should never be more than 1% of our total credit book, which is currently about 49,000 crores. So we have tried to maintain that as much as we can. And on the tax rate, you are absolutely right. I think it's the insurance losses that we have which gives us this higher tax rate on the consolidated accounts.
in that case, I mean, once if these insurance subsidies turn profitable, then can we expect that effective tax rate to come down? I mean,
yeah, actually, not only it will come down, it will actually be better because the insurance business will have a carry forward loss. Yeah. So hopefully it won't pay tax. So you'll have profit without tax. Currently we have, we have the loss on that where we are not getting the offset.
Okay, thank you.
Yeah, but I think overall you are right. The tax rate will come down when insurance breaks even.
Okay, thank you.
Thank you. The next question is from the line of Subhranshu Mishra from Motilal Oswal Securities. Please go ahead.
Hi, sir, and thank you for the opportunity.
Subhranshu, may I request you to speak a little louder? Your voice is very low.
Can you hear me now?
Yes, thank you.
Right. So thank you, sir, and just wanted to reiterate on the wholesale mortgage book. I want to understand the number of accounts, if you're not giving out the names, which would certainly give a lot of comfort to the investors, but the number of accounts and where all they are domiciled. In specific, how many projects in Bombay, how many projects in Bangalore, how many projects in NCR. If that can be done, that's the first question. The second question would be around the risk management practices in loans against shares. If you can please tell us what kind of LTVs and what kind of promoter funding is there in loans against shares.
So first of all, on the first one, we are largely present in 6 markets, which is Mumbai, including MMR. And so Mumbai and Pune is about a third of the book total. Then we have NCR, then Bangalore, then Chennai and Hyderabad. These are the 6 markets in which we are.
What's the proportion?
And, as I said, I think Mumbai is about a third. Mumbai and Pune would be about a third. The balance would be, NCR would be about 25 to 30%, and the balance is distributed across Bangalore, Chennai, Hyderabad also.
Right. And the number of projects, if you can give us in each of the markets?
As I said, I think the number of projects total should be about 60, 65 projects at any point of time.
Right. And the risk management practices and loans against shares, sir?
Yeah. On the loan against shares, a large part of the book is what is called ESOP financing book, because we are one of the leaders in ESOP funding. So almost 75% of the book is ESOP financing, which are to individual high-level executives in banks and others, where when they exercise their ESOP, they borrow against that. The balance 25 is also a margin funding book. There is no promoter funding or promoter financing in that book. So it's called loan against shares. It's mainly for our wealth management customers and for ESOP financing. And the LTVs in that are approximately about 50%, and we have no delinquencies on that. Even in this entire recent fall and everything, there has been no forced liquidation, nor has been there any NPAs on this book.
So have the LTVs somehow fallen and you've asked for additional shares in this period of time?
Yes, yes.
Okay. Sure. Thank you so much.
Thank you. The next question is from the line of Rahil Shah from Ambit Capital. Please go ahead.
Thank you, sir. So how much borrowings was done through the banking channel post-September? If I collected the number right, overall you raised around 2,500 crores.
Yeah, we got approvals about 2,500 crores from the banking channel. We also have raised
about 1,000 crores from the banking itself and about 1,500 crores in the form of commercial paper.
Okay, so the bank disbursed around 1,000 crores to us post-September.
That's right. Maybe from the 24th of September to be precise.
Yeah, okay, post that event. And what is the incremental borrowing cost? So both on banks and CPs?
Well, it has been about 40 to 50 basis points more than what we would have normally paid.
Okay, fine. And so your now 40% of the book is large wholesale and to corporate credit. So with this cost of borrowings inching up, so how we are placed in terms of pricing? Like we would be able to pass on this increase to the new customers, or we will look out to disburse, like we'll slow down on the disbursement.
As you said, the wholesale book we are increasingly anyway doing it in the fund. So on the wholesale side, but I think if your question is there price elasticity on this, the answer is yes, we can pass on this. We have done that. So if you see last 8-9 years, our NIMs have been fairly steady. In fact, even on the SME book and the small ticket home loan, as the cost has gone up, we've been able to pass it on. What happens in a lot of these books, you have things like processing charge and all that you normally waive off. When things like this, when you want to increase the price, you start, reducing the waiver on processing charge and adjust your actual yield on that basis. So in our investor PPT also, we have a slide which has shown our NIM across various, on slide 23, we also see how the NIMs are steady. So we feel that there are parts of our book where price we can pass on. And also remember, our liabilities are also only about a third of our liabilities are getting repriced, not the entire, all the liabilities are getting repriced. We have a lot of, our book is, our borrowing is also more than 3 years at a fixed rate.
55% of our borrowing is above 18 months and plus, so there is no question of repricing there any which way.
Okay. So from this level, like from September end you are saying, or from FY18 end you are saying?
September.
From now, so as I said, I think what happens when interest rates go up, your assets get repriced and your liabilities get repriced. And how you manage the asset repricing, liability repricing is your entire interest rate sensitivity approach. What we have found usually is our NIMs get impacted around 20-30 basis points. So if you see last many years, our NIMs have been between around 7.5, and they hover around 20-30 basis points above or below that, depending on this interest rate sensitivity that is there. And we always maintain that we will try to maintain NIM at 7.5 plus or minus half a percentage point, and that is, I think, achievable in spite of this recent increase in cost of borrowing.
So we are not looking to slow down on our disbursement on both of this exposure?
Not because of interest rate, but obviously liquidity is the reason everybody has slowed down. So I think for the next 5-6 months, we will continue with retail and SME, but on the wholesale ones, I think overall there might be slowdown until the liquidity conditions come back to normal. But as I said, in our case, we were always planning to do incremental. A lot of the wholesale now happens in the fund structure, so that will continue on that count.
Okay,
so I don't think the interest rate cost is going to be an issue for any slowdown. I think currently next 5-6 months, everybody will focus on liquidity and calibrate their growth according to liquidity available in the market.
Okay, fine. And so last question, so everyone has concerns on the real estate exposure, in fact, for the entire industry. So, sir, if you, you cannot share the names and all, but if you can share your underwriting guidelines or something, how you go about giving or sanctioning a real estate loans, so that would be also helpful for us to understand. So this was the last question.
Sure. No, I think there are two parts of, I think one is underwriting and the other is post-underwriting. So underwriting, as I said, we have focused on housing because housing is a self-liquidating asset. Unlike an infra project where even after you complete the project, you can't sell that project. There is no exit available. In housing, it is a self-liquidating asset. So that's why 95% of our book is in housing. We also make sure almost 100% of our projects are RERA approved. They are completely, RERA approved. 90% of projects, we are the sole lender because we have realized that at the project level, at an SPV level, your risk management is much easier if you control the project. And if you don't have other creditors with whom you share pari passu charge, it becomes a lot easier. We also found that apartments or houses which are below 1 crore is where the demand is very strong. Actually, it is around between about 50 to 75 lakhs on an all-India basis and around 1 to 1.5 crores in Mumbai. So this is the range at which the demand is very robust. So 80% of our inventory is below, 1 crore category. But as I said earlier,
under construction, exposure to under construction projects? Hello?
Sorry, I don't understand what you mean by under construction. Because all projects are under construction only. We don't do LRD.
Okay, understood. Okay. Sorry to interrupt, sir. You were explaining.
No, I was just saying that what is important also is over the last 10 years, we've also built a very robust post-disbursement risk management group where we do project management. We have people who actually worked in real estate over the years. They've run projects who are part of that team. So we do very active monitoring. We do active project management. Plus we have a sales and distribution team which also can sell apartments and homes. So we, I think on an average, have sold anywhere between 20-30 apartments a month to 40-50 apartments every month on an ongoing basis. So we also have sales capability. We have project monitoring capability, as well as in our ARC, we also have distressed asset management capability to ensure that projects get completed. Because in real estate, housing especially, we have found that completion of the project is the most critical variable. If you complete the project, everything gets handled.
Yeah.
The amount we have sold is about 100,000 square foot per month in the last few months. Has been on our own inventory. Our own distribution team has sold close to 1 lakh square foot every month.
Okay, fine. Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Amit Goyla from Rare Enterprises. Please go ahead.
Yeah, hello. Yeah, Rashesh, hi, Amit.
Amit?
Hi. Somebody had asked this question and you had said you won't be getting into the details. This is about SR. I was just wondering, because the amounts involved are so large, and since you're the second largest lender over there, like what kind of flowback can happen and what kind of profitability can come through? I was just wondering on that.
See, again, it's not prudent to talk about individual account economics and profitability because that takes away the focus on the portfolio. And we have said, look at this as a portfolio. The total, I think, receipts on SR we will get, you should remember 85% of that belongs to banks because all these are in the SR structure. So most of them we have done 85-15. So most of the upside that will also come will go to the bank. What we will end up getting is some incentive and carry that is as per the structure that we get. But I think for us, from a cash flow point of view, a lot of people have asked us, SR and FR plus, Binani, total cash coming in, not profits, but cash coming in should be about 2,500 to 3,000 crores in the next 5-6 months. But overall, I think profit will vary account to account depending on what IRR is there and all. And I think as and when it comes, it will be reflected in our results.
Okay. Thanks, Rashesh. It's been a difficult time for you guys. All the best and hope that you guys come out of this pretty
Thank you, Amit. Thank you.
Yeah, bye.
Thank you. The next question is from the line of Nischint Chawate from Kotak Securities. Please go ahead.
Hi. Essentially 3 questions from my side. First is on the corporate and the real estate business. Based on, I'm sure you've done a detailed, update exercise. So how comfortable are you about your book? What kind of pain points do you really see? And in this backdrop, would you be running down the wholesale book?
So, Nishant, as we have said, I think the wholesale real estate corporate book is, according to us, is a good risk-reward book. But, there is always a difference between NPA and actual recoveries. And our experience has been that usually recoveries are very high, almost 100%. You don't lose money on this deal, but they do have chunky NPAs and all. And hence we have always felt that more than an NBFC structure, this kind of strategies should move to a fund structure. So last 3-4 years, we have raised parallel funds, and our idea was that slowly and steadily, we book more and more of this in the fund structure and only keep a small part of that on the NBFC, the co-invest part on the NBFC. So we do expect that in our corporate book, I mean the wholesale book, both of these put together is about say 20,000 crores. We expect to get about 4,000 to 5,000 crores coming back every year. It's the average tenure is about 4 years or so, 3 to 4 years. So, and my expectation is if we get about 4,000 or 5,000 crores coming back every year, we might be, redeploying about 1,000 and a half every year because that will be our co-invest share for this book. So this will come down a little bit over the years, but along with that, we'll grow our ARC book will hopefully continue to grow, and the retail book will continue to grow. And that has been our stated strategy for the last 3-4 years of allowing our balance sheet to be more used for retail strategies and using funds for the more and more wholesale strategies.
Sure. The second thing is, on the entire contagion on the sector, given the fact that, real estate or the developer lending is sort of, reduced significantly today, and maybe some of the NBFCs would have gone significantly slow on the retail side as well. So how do you see a contagion or a risk in the sector, and what is the way in which we could come out of this?
Sure. I just want to add one other thing, that if you look at even the loss given default on the wholesale real estate book, it has been about 7.5% on stage 3.
Actually, less than 1 we have provided.
We have provided 7.5, but actual experience has been lower than 1. So as I said, you may have NPAs, but you will have also very high recovery rates in this kind of books. I think the contagion issue is an important one. But what happens is at a project level, there is not much impact on contagion because hardly any project is dependent on refinancing. All projects that we have are dependent on project completion and sales. So what I think, if there is no incremental funding available for real estate projects, then the new projects will not get launched because usually you try to do a financial closure when a new project is being launched. So we will see a step back on new projects happening, but on existing projects where the financial closure has happened, where you have structured it in a way that, between the cash that has already been invested plus the customer flows and construction finance and all, that project will get completed. And that's why I said, as long as home loans are happening, as long as home sales are happening, the project will get completed. In housing, we have seen when the project gets completed, usually all your risk gets mitigated, and our average cover is about 2 times. So even if there is a 5-10% fall in pricing, it won't erode the collateral cover too much. So the key is, will home sales continue? Will home loans be available for people to buy homes? And will the project get completed? Because unlike other parts, here the contagion doesn't affect a particular project. If that project has got its funding in place, that project will get completed. Because even if outside funding is not there, that project is not impacted by that. And that is why we constantly highlight the fact that SPV level management is very, very important. So there are 2 parts. I think one is at an SPV level, and we saw that in infra also. If a road project got completed, there was no risk in that. But unlike a road project, where there is no liquidity event at the end of it, in homes, there is a liquidity event because this is a self-liquidating asset because people buy homes. They take home loans to buy homes. So as long as that continues, we don't see, in fact, as I said earlier, I was truly more worried at the demonetization stage because that could have impacted the economy as a whole and could have impacted home sales. So I think on projects, at a project level, there will be some project, if there is a funding gap, it will struggle to get additional funding, but there also there will be ARCs and there will be other, stress funds and other funds who will provide. As I said, we are also looking at a fund to provide some last mile funding or completion funding for good projects which are stuck. And we have done that in a quite a few cases. Not only us, other ARCs have also done that with malls and hotels and commercial buildings in the past. So I think in that, I don't see a big contagion effect for the whole sector as a whole.
Sure. And just one final question, and this was actually on the asset management side of the business. With the regulations changing on mutual fund TERs, how do you really see both the asset management and the wealth business evolving? And do you see a risk that, given the fact that there is going to be, the TERs on mutual funds reduce, it could have some rub-off in terms of the PMS business as well? Thank you.
Yeah, I think, in fact, if you see our asset management, wealth management, there has also been a lot of focus on alternatives. And I think this particular market dislocation that is happening will shift some of the strategies from NBFCs into alternative funds. Because as I said, the advantage with credit funds is that they don't have ALMs and they don't have, NPA issues because they are not, borrowing. So given that there is the NPA issue and the ALM issues are not there, as long as the risk reward is good, as long as recoveries are there, even for projects that go into NPA, I think the fund structure might be a more appropriate one. So I do think that this will bring about more focus on private credit funds or more alternatives. So both our asset management, wealth management, there has been a huge focus on alternatives. So I don't think the recent mutual fund changes will affect us much. In fact, after all this settles down, we think this will give a much stronger boost to alternatives, especially alternative credit funds, because India needs, historically we had the PSU banks providing credit, then we got the private banks, then we got NBFCs and HFCs, and I think after all the recent events, we'll have the private credit funds also providing other kinds of credit. So different strategies will come through different organizations, whether it's NBFCs, HFCs, and funds. And I think in our asset and wealth management business, we built a strong franchise. Our customer, satisfaction rates are very high, and a lot of our customers are looking to us for innovative products and which happens through alternatives. So I think mutual funds will always be there, but increasingly for any wealth manager, the dependency on mutual fund fees will be smaller, and you will be more and more focused on alternatives, on brokerage and execution services, and on things like margin funding and credit services.
But would the fees on alternatives also not come down, just as a kind of, just because mutual fund fees are coming down as well?
I don't think so. In fact, they will go up, because there will be more demand. Because creating an alternative platform will take some time. I think it takes about 4 or 5 years to build an alternatives platform. Even if you see globally, there is, BlackRock, which is a big mutual fund outfit, while there is Blackstone, which is a big alternatives outfit. So I think the age of alternatives is upon us, and alternatives has its own requirement of skills and capabilities and building the platform. So I currently don't see that alternatives fees will come down.
Sure. Great. Thank you very much and all the best.
Thank you.
Thank you. The next question is from the line of Kushan Parekh from MK Global. Please go ahead.
Yeah, hi. This is Jignesh here. One of the questions just been asked on this mutual fund part, this TER getting reduced. So I understand that, the alternatives would be compensating for you. But overall, what's your look or what's your view on this entire episode of TR shrinking out here? Do you think this is overall going to impact the brokerages or even wealth advisors to cut down the cost and to shift towards not only to alternatives or to have a lesser focus, or even mutual funds should be cutting down on the wealth advisors or going for more direct? What's your overall view on this? Not only for Edelweiss. That's my first question.
Sure. I think overall you are right. I think what will happen, volumes will go up, fees and commissions will come down. That has been the trend everywhere in the world and even in India. And you will use a lot more technology, training, and scale benefits to compensate and get higher profitability. The same thing applies to even the mutual fund itself. I think you look at most of the mutual funds, their overall fees may come down, but with scale and technology and economies of scale, their profits might go up. So I think we see the next 10 years on that line only, that as long as, because India is still scaling up well. We see household wealth going up by $500 billion, $600 billion a year. And, the banks are flush with a lot of liquidity, so the bank rates may not go up. And as a result of that, people will look for yields, which will come to mutual funds, which will come to insurance companies, and will come to alternative funds as we go along. So I think we have seen that in the brokerage industry also, commissions coming down, scale going up, and costs coming down because of use of technology and economies of scale. And I think that will be the name of the game going forward.
Okay. Thanks. Now, my second question is pertaining to your not specifically to the developer finance from your side, but now obviously there has been a crunch, and you are seeing one of the name has like Supertech has already been announced that there have been some stress. Do you think this scenario is getting built whereby over-leveraged developer, there could be a cycle of default might happen, or there will be one large guy or a couple of large guys might see a stress and a chain of default starts from the developer side? Now this I want your view as as an industry perspective rather than just from Edelweiss point of view. Do you think there is a probability building up by, if this scenario continues for next another say 30 days or 60 days, there will be some large default might happen on the developer finance side?
See, again, as I said earlier, we should remember most of the real estate project financing is at an SPV level. Very few people are doing holdco funding. Everybody is doing financing at a project level. Most of the financiers can control the project. We have done, we have changed developer from one developer to another on a particular project who could not execute. Even today, a lot of the large developers are always in touch with us that if any of your project is stuck, they are happy to come in as a what is called development partner, DP model it's called. So I think it's very important because there is a lot of, misunderstanding and misinformation on this contagion effect, and if a guy defaults, will everybody, because most of the credit is at a project level. The project is very insulated. So because as long as that project gets completed, it has no connection or no correlation with anything else on the funding side with other people. If a developer defaults on one project, he might still be able to continue on the other project if the financial closure and sales on that project are going well. In the early days, there was this problem because if a developer was feeling cash crunch in one project, he would take money out of other project and put it out here. And that was the largest risk until a couple of years ago, that the contagion within the developer, if a developer is doing 8 projects and is struggling on one project, slowly and steadily all 8 projects will start feeling the financial crunch because he will be moving money from one to another. The good news is now with the new law, the developer cannot move money from one project to another. 70% of the cash flow of the project has to remain at the project level under law. It's a criminal offense to take money out of the project. And all the cases you hear, whether it's Amrapali, whether it's Unitech, whether it's JP, all of them, a lot of them are cases where money was taken out of a project to fund something else. What we have found is as long as the money is in the project and the project gets completed, the risk is low. So I think the new law is a very important one. And our real confidence in this whole business has got, underscored after the law was passed. Because now, earlier, every creditor, like all of us, had to do project monitoring at a very intense level because we needed to make sure. So I remember when, demonetization happened, we were extremely paranoid and we were constantly looking, saying, will any developer take money out of the project we have funded into some other project? So we were intensely focused on that because at that time the law was not there. Once the law is in place now we know that it will be a criminal offense for anybody to try that. So I think currently the market is very spooked and there is this whole theory going on that, all the real estate projects will fall one by one after each other. But the good news on real estate is every project is independent. Every project is insulated. Every project is ring-fenced. And as long as the project, and that's why I keep on harping that 95% of a project, we are the sole creditor where we can decide. We can change the developer, We can bring in some fund who will provide last mile funding. We can cut prices and force him to sell more inventory. All of that can be done if you have control of the SPV and at the project level.
So just to add on this, this was really helpful, but just to add it on, so do you think a consolidation in the developer or the real estate sector is most likely over next 3 to 5 years, you see a consolidation happening and very selected players getting very strong or much stronger than what it is right now? Do you think that kind of scenario building up? And then, more of a developer finance guys are having more exposure towards those limited guys? Do you see such kind of scenario happening? Why I'm coming to this is because this particular segment looks to be, most vulnerable from the market perspective. But, if NBFCs wants fund them, then we are not seeing overall growth in the economy coming. It's a very important segment overall for the economy. So am I asking that you feel that there's a consolidation in the sector?
I think it's been going on for the last few years. But if you look at anywhere in the world, it's like any services business. You look at IT services, look at financial services, you look at real estate. It's not a very oligopolistic market. There are not only 5 players because India is a large market and, every city is different. So I do think consolidation was anyway underway because in the last 5, 6, 7 years, a lot of the small developers who were doing one project here and one project there were either becoming insignificant or were getting marginalized. But I think what will happen most likely is the weaker developers who have a good project will partner with the stronger ones. I think this entire development partner model, and if you look around, there have been so many cases of that already in the last 3-4 years, where strong developers, they don't bring their capital, because everybody has only limited amount of capital. And one of the biggest constraints for an oligopolistic industry is how much capital can be put to work. No developer can say, I'm going to bring, $10 billion to work on that, because you need capital to do projects. So I think a lot of the slightly weaker developers who have good projects, who have got the land, who have got the approval, but may not have the brand name and the execution capability, they will partner with the stronger names. And it has happened with us also. In a lot of cases where a developer approached us and we said, no, we can't fund you, but we will introduce you to so-and-so. If that builder is willing to partner with you, we will fund him, and then we will fund the project. And we have done at least about 10 to 12 cases of that, where we have said good project, but we also need a good development partner for us to be comfortable to fund the project.
Sounds good. Just last one from my side. Your overall adequacy at a console level has almost reduced from 19.5 in December to close to 16.1. Pardon me, my numbers are just a little here and there. But what's your take now over this 16% sort of an adequacy? Do you think the capital raising would be a little faster or a little earlier than what you were projecting? Any view over capital raising or selling some stake or something like that? That's it from my side. Thanks a lot, sir.
I think this 16 would be higher by at least half percentage points or more, because we're currently holding a lot of cash in the mutual funds. And mutual funds carry 100% risk weightage versus GSEC, which carries, 0% risk weightage. So as a result of that, and we also have some FDs in banks which carry, I believe, 20% risk weightage, because as you know, we are holding a lot of cash. I think everybody is just holding cash for all the future obligations. And this cash has been invested in mutual funds, and also part of that is the risk weightage on the cash we are holding. If you convert this into treasury bills or GSECs, the capital adequacy will go to between 16.5 to 17% very quickly. Okay.
But do you plan to raise capital, or any plan which you made? What will be your expected period by when you will need capital to sustain a 30% sort of a growth? I know
we have always maintained that first half of 2020. Fiscal 2020, which is the next year between April to October, we might have to, we will raise capital. We have always indicated that, and that has been part of our growth strategy. And we think we'll continue with that, because as I said, this turbulence will die down, and and there will be growth opportunities, and growth opportunities will require capital. So I think we are maybe about a year or 3-4 quarters away from that.
Sir, this is Jignesh's colleague Kashyap here. If I can squeeze in two questions, quick questions. One, you mentioned about the developer financing is that, whenever there is even a, problem at a project-specific level, there are multiple options available to you, which is to change the developer or, a forced sale of inventory. One question that, when that happens, do you believe that there is a contagion on the real estate asset prices down the line if this does not get unjammed in, let's say, next 2-3 months? That's question number one. What happens to the real estate prices then? And question number two is that if you look at slide number 16 in your presentation, the second one, point number 3, which is historical recovery of default cases, there is 84% cash recovery and then rest is in the other assets. If you could share your experiences, in this rest in the other assets kind of recovery, how was there any revision in the asset prices? Was there, any you might have recovered your full money, but was there any haircut on the part of the owner of the asset?
Yeah, I think the first question was, you said, will there be a contagion on real estate pricing and people will cut prices? I think the good news is that last 5 years prices have actually not gone up, but actually come down. As a result of that, I don't think there'll be indiscriminate cutting of pricing, but there'll be structuring that will happen. I think people will take more cash up front and be willing to reduce price for that. I think that will definitely, the outcome of this liquidity will be the more cash you're willing to pay up front, the more you can get, a lower price. But I don't see a price war breaking out because 5 years prices have not gone anywhere and the actual demand is there. So I think people will try to incentivize more cash payments rather than just indiscriminate, price war out there. On the second model, on the second thing, when we say 84% cash recovery and rest in other assets, very often we have either the personal guarantee or we have their other assets that are pledged with us. We can take that also over and liquidate that. So I think at a project level, we've been able to recover 84% money. But then after that, we use other ways of recovering. So up till now, we have recovered 100% of the money. But as I said, these are the businesses where you have NPS, but very chunky NPA with low loss given default. And that is why a fund model usually works very well.
Actually, my question was that if in this rest in the other assets, if there was any forced sale of inventory, what was your experience over there? If at all there was a forced sale of inventory.
See, there is no forced sale of inventory. What you do is you take inventory and then you liquidate in a structured way. So in some project, you will get money and then you will end up taking 3 flats or 4 flats, and then you will use your distribution team to sell it over a period of time. But in your book, the moment you have taken the flat at a discounted rate, you have at least known that your recovery has been done and you can close the account and go forward. And then you can take your time to sell. So there is no such thing as forced liquidation. You have to do it very sensitively. But usually, this 1 crore and below is a very price elastic market. So you tweak it a little bit, you give a little bit of, extra, you don't charge, what is called the plus, which is the flow rise and all. And you can actually move inventory fairly significantly, because this is the market where 4-5% fall in pricing can lead to a change in demand. It's a very price elastic market.
And when you said you do 95% sole financier, would you do end-to-end project financing, start from from the start point till the last floor is built?
No, usually we come after the land and the approval has been done. Usually the way this works is the land and up to the approval stage, where equity like that, the developer puts his equity, he has some equity partners, some funds, equity funds come in there. And after that, we do what is called project funding. Then there is construction financing, and then there is, actual sales that happen. So usually we come in at a project finance stage, and either we do construction financing or we help them get banks to fund construction finance, which is usually a small part. But at the project stage level, we are the only financier.
Okay. Thank you very much, sir.
Thank you. The next question is from the line of Vikas Garg from L&T Mutual Fund. Please go ahead. Vikas, your line is in the talk mode. You may go ahead with your question.
Yeah, thanks for taking the question. On the slide number 40 of the PPT, it says that the liquidity cushion on balance sheet is somewhere around 3,300 odd crores. And then on the slide number 46, it again says that the cash and the liquid assets are 6,900 odd crores or so, where the breakup is again given in the below over there. So there is an additional cash and the liquid assets to the extent of 3,700 odd crores as we speak. Thank you very much.
Yes. So we actually differentiate between liquidity cushion and treasury assets. So the other part that you highlighted very correctly are the treasury assets. Treasury assets can be in form of either GSECs or cash future arbitrage or things like that. Usually the treasury assets are part of the charge that we give to banks, while the liquidity cushion is free of any charge or any encumbrances from anybody. So what we call liquidity cushion is the cash that is available to us, which has no charge to anybody. While the treasury assets, since they're part of the same entity in which banks have given loans, they have a floating charge on that. So but the treasury assets are also liquid assets. We can raise cash against that. So what you are seeing is A plus B.
Okay. So will it be safe to assume that the A side of it, the cash and the liquid assets, you would already have some kind of the borrowing against that one-to-one, in a way that if you were to unwind all those assets, liquid assets, so one-to-one your debt side also would come down to that extent, while the on-balance sheet 3,300 crores is completely unencumbered, in a way that there is no one-to-one matching of the debt side on that book.
No, actually, the treasury assets, except for CBLO that we had shown, that is only back-to-back borrowing that is there. Outside of that, there is no back-to-back borrowing. So the treasury assets are liquid assets, but they have a floating charge of the banks who have given loans into that entity. So it's not a back-to-back at all. It's a liquid asset. So you can, for liquidity purposes, it is immediate cash available to us. If you have to raise cash tomorrow against it, we can raise it. But as I said, the liquidity cushion has no encumbrances or charge, even a floating charge against it. It's completely out of that.
Okay, yeah, that's very helpful. And if you can just also give the breakup, or not the breakup, but your broad nature of this liquidity cushion of 3,300 crores. Is it like a pure cash which is sitting, or it would be into some liquid investments or something?
It will be in mutual funds, it will be in government securities, and it will be in FDs in banks.
Page 40 has the details. Page 40 has
we have the details of that on page 40.
Okay. Yeah, thank you very much.
Thank you. The next question is from the line of Viral Shah from Credit Suisse. Please go ahead.
Hi, a follow-up from Sunil Tirumalai from Credit Suisse. Sir, your NPA number, has been creeping up. 1.78 seems to be, kind of an all-time high. On a fast-growing book, such a rise in slippages is a bit worrying, and especially if you're talking about slowdown now, it's like, so that percentage number is likely to go up even faster. So can you give some color which segments are, driving the rise in NPAs, and, what's your outlook on that? Thank you.
See, overall, we have said as per model that we run, our overall NPAs, gross NPA at 2% and net at 1 has been our guidance going forward. So we are in that range itself. And as we are growing, our retail NPAs are slightly lower. For wholesale NPAs, we think over between 2 to 2.5%. But as I said, NPA with a very low loss given default on that, while the retail NPAs the gross NPAs are around 100 to 120 basis points because there is a large, housing finance book also on that. So, overall, our weighted average with the mix that we have always said the model should be around 2% gross NPA and 1% at NPA, and we should be able to stay there. As the mix undergoes a change, this will change a little bit, but we don't on a structural basis see a big change in the mix. It might happen for a quarter or two if, a couple of 1,000 crores of loan against shares is scaled back. But overall, we think retail will continue to grow and become larger and larger part of the total book. And since the retail NPAs are around 100 basis points lower than wholesale NPAs, we think this model will continue in this range itself.
Okay. And my next question is again going back to the real estate book, where you said you have fairly tight control and oversight into the project level. Would you have information on the buyers of homes in that project? I mean, do they normally buy, without financing, or how much financing is done by banks? How many of them buy through home loans given out by banks or HFCs? Some color on that would be helpful.
So, I just also wanted to add on the asset cover you had said. We have also 56% provisioning that we have taken on our the NPA that you are referring to, and actually this is slightly higher than the loss given default that we actually expect. So I think we have always followed the methodology of having NPA, providing for it, and having some cushion on that. So we hope that we maintain our recovery rates that we have maintained over the years. On the home loan, I think almost 80-90% of home loans of these projects are with a home loan. So there'll be very rarely apartments in this project which are sold without a home loan. And home loan market has been about 55% of the via banks and about 45% non-banks, which includes HDFC and others also. So if there is a slowdown in home loans by some of the housing finance companies, I don't think it will materially impact the overall profile. In fact, on every project that we have funded, there are usually 3 or 4 home loan companies which have a stall there. Very often there'll be a PNB Housing, there'll be an HDFC, there might be a State Bank. So usually every project has about 3 or 4 housing finance providers who are also at the project itself.
Okay, that's helpful. Thank you.
Thank you. The next question is from the line of Daniel Desai from Qtr2 Capital. Please go ahead.
Hi, Rajesh and team. Good afternoon. I have 3 questions. First question is on the liability side. I think with the way things have moved, I think one thing is emerging that mutual fund have been lending to NBFCs and almost 35-40% concentration kind of a number. So that number may eventually come down from the risk mitigation for mutual fund guys. So how do we see our liability strategy changing going forward? Are we going to do anything different to ensure that we have a lot more diversified sources of funding, if you can throw light on that? My second question is with respect to our asset management and wealth management business. I understand that our capital market business is quite cyclical with high operating leverage playing out on both the sides. But how is the case in terms of wealth management and asset management business? I mean, are they also as closely linked to capital markets, or are they, kind of slightly, the correlation is slightly on the lower side? And third question is, in the wake of the recent dynamics and our intent to preserve liquidity and hence kind of flow on growth side, how should we look at our guidance or aspiration of growing our profits at 25 to 35%? That's it from me, sir.
So I think on the first one, if you see slide number 42 on the investor PPT, we have shown that mutual funds are totally about 32% of our total borrowing, but about half is from CP and half is from NCD. So I think the NCD is the more important part. I think the CP is a smaller part of the problem because the total outstanding CPs, as I said, even if they shrink by half, it won't change much overall for the industry as a whole. Of course, if your profits were dependent on the ALM arbitrage using CP, then your profit will get impacted. But as I clarified earlier, we had never used the commercial paper for an ALM arbitrage business model. So if you see on that slide, you will see that retail has been 17% of our total borrowing. These are the retail NCDs and bonds that we issue. Our long-term target on retail is about 25. So if you ask me, it should be about 30% banks, about 25% retail, another 15% NCDs, maybe about 5 to 8% commercial paper, and balance would be others like insurance companies and international borrowing. So I think part of the mutual funds will get replaced with retail on a longer term basis, which might have slightly higher cost, but will be more longer term and more stable. We have always kept banks at between 35 to 40% over the years, and that will continue to remain that, because I think having that part of your borrowing from banks, and this is across quite a few banks, is also another source of stability, which has been underscored in this time also. So I think overall having that mix will continue. On the cyclicity of our asset management, wealth management business, a lot of our asset management is A, alternatives, and B, in credit. So the equity market cyclicity doesn't affect it as much. Of course, right now the credit market is also going through an upheaval, but for them actually there will be more opportunities in that, as a lot of credit starts to move away from NBFCs, also starts to move away from mutual funds into the private credit funds. I think large part of this problem happened is because of the mutual funds exposure to ILFS, because the investors in mutual funds are comfortable taking interest rate risk, but are not comfortable taking credit risk. So whenever there is a credit risk, like what happened with ILFS, investors in mutual funds get spooked. So I think as a result of that, the credit risk part of it, where the credit risk and credit reward will decide, will increasingly go towards alternative credit funds. And that has been our hypothesis for many years, and I think that hypothesis will get accelerated with this recent development in the market. In terms of liquidity, we are all conserving liquidity, going slightly slow on growth, and I think for the next couple of quarters, for everybody, growth might take a backseat, but on the longer term basis, it won't change much. And fortunately, everybody had good growth in the first half, so a little bit of scaling back of growth in the second half to just adapt and adjust to the liquidity environment will actually be more prudent also. So we have actually refrained from giving a very concrete guideline on what the real numbers will be. We do expect that Q3, Q4, some growth shave-off is inevitable because everybody is going to hold cash just to be on the safe side. But I think once things come back to normal, especially given a lot of our growth in credit was coming from the retail side, and we see opportunities on that. We see opportunity on wholesale also, but as we have always said, wholesale will more and more be captured by the fund strategy. And on other parts like asset management, wealth management, capital markets, insurance, we think there are no real structural changes as a result of this.
So the trajectory of 25 to 35% on a longer term basis doesn't change, with the fact that the quarterly basis for a couple of quarters we may be soft on the growth side. Is that a right understanding?
Absolutely.
Okay. Thanks. That's it from my side.
Thank you. The next question is from the line of Jigar Shah from Maybank. Please go ahead.
Good afternoon. Congratulations for strong results. My question is largely answered, but would still like to know from you on the second half, what is the outlook considering the scenario that is prevailing, and particularly which factors positive for the sector as well as for Edelweiss, and which factors negative for the sector and Edelweiss should be kept in mind, especially for the next 6 months?
I think I've given the answer. It's the same thing. I think the next 6 months, depending on how quickly things come back to normalcy, people will hold cash. And actually holding cash is an expensive thing, right? You can estimate you're currently holding about 7,000 to 8,000 crores equivalent of cash and cash equivalent. That is not a very profitable, activity. So I think the next 5 or 6 months, growth will get shaved off. I don't know how much, because it depends on how much the markets come back to normalcy, how quickly they come back, and what happens to interest rates and others. But I think fortunately over the next couple of years, we also have some tailwind on our ARC business, because ARC recoveries will happen, and with recoveries, some carry and some incentive income will also come by. So if there is some adjustment in profitability in one part, hopefully it will get adjusted, and that underscores a diversified model that we have. The same thing, if at all this real estate financing risk, as everybody has been articulating, if it becomes real, then ARC will have an opportunity, because ARC will be able to fund some distressed real estate projects and provide last mile funding and all. So our diversified model allows us that every challenge can also be an opportunity, and every threat can get converted into some part of the business will capitalize. So I think as a result of this dislocation, ARC and our asset management, the private credit business, will clearly see some benefits and opportunities out of this.
Okay, thank you so much and wish you all the best.
Thank you. The next question is from the line of Abhijit Sakhare from Goldman Sachs. Please go ahead.
Good afternoon, sir. Sir, I had a few micro questions on the alternatives business. So just broad, guideline on what's the typical life of these funds. Are these typically, close-ended funds? What is our contribution? Is it all in the form of equity? What's the fee structure like? What's the hurdle rate? And since this is a credit fund, how does the NPL recognition work? So just broad thoughts on these lines.
So these funds are usually structured like your private equity fund. They are on calling basis. So you call in money when you do the deals, and you also repay the money as the exits happen. So it's like in that sense, a private equity structured fund, though you do credit strategies on this. So they are usually about between 5 to 7 years. Usually you have a 4-year investment phase and a 2-year exit phase, but different funds have a different life. We also have funds with 10-year also. The infra yield fund is a 10-year fund. We don't invest into the fund. The fund co-invest with us. So when we do say a 200 crore deal, and if at all 20% is supposed to be ours, then we would, from our NBFC, invest 40 crores as one, credit deal, and the same deal, the fund will invest the remaining 160 crores. So we don't invest our money into the fund. The fund co-invest on credit deals along with us. But the fund operates independently. We have a formula that it will be 80-20, or in some funds it is 90-10, where 10% is our part of the deal and the other 90% is the fund part of the deal. So different funds are structured differently. They are all co-investment, because the investors in those funds want to invest alongside us. They have seen our books, they've seen our strategy, they've seen our capabilities, and they are saying that we want to invest alongside you. So if you are doing a deal and putting 20 rupees, we want to put 80 rupees along with that and participate in that fund strategy. So, and usually on a fund, we make a fee and carry of about 3%. About half comes as a regular fee and the other half comes as a carry when you exit. So as you exit, you have a threshold return. There is a hurdle rate. And what you make above the hurdle rate is usually rupee rate. And whatever you make above that, you get a fee, you get a carry on that. So on an average, you end up making between 2.5 to 3.5% annualized fees on that. But you get half of that as a normal fee, management fee, and the other half comes as a carry.
Okay. And the NPL recognition is like normal NBFC cases, right?
So on our part, it's on NBFC, so it is NBFC. The fund is like an AIF or a closed-ended fund, so it has no NPA reporting requirement. But
you value the instrument.
But the instruments get will get valued if there is any impairment. So it's not just NPA, but NPA and loss given default. It gets adjusted in the NAV valuation of the fund.
Okay, understood, sir. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
So, I want to thank all of you for being there. I mean, there has been so much that has happened since the last call we had. So, truly happy to interact with all of you. We're grateful that all of you have taken time. Also, not only on this call, but even offline, giving us inputs, asking us questions. And I would hope that we continue these interactions. Please do contact us, me and my colleagues, whether you contact Ramya, Salil, anybody in our stakeholder relation team, we will be happy to get feedback from you, but also answer your queries, whatever you have. Thank you very much.